Hello, everyone, and thank you for attending the Nelson Capital annual presentation, Inflation Not So Transitory. We've got a great presentation for you here today, but first I'd like to begin by introducing our team. So with us today as panelists, we have the Nelson Capital partners, Brooks Nelson, Steve Philpott, Darcy Nelson Smoot, and I am Evan Nelson. Also as a panelist, we have Dr. Ann Oglesby to answer any of your coronavirus or vaccine related questions. Chrissy Domingo is one of our research analysts, and we have a new research analyst joining us this week in Donald Horton. On the wealth management side, Marissa Wisniewski and Tiffany Young, and as well, we've got a new employee with Kelly Bojo. So we're happy to answer any questions you may have at the end of the presentation, but feel free to ask them throughout by clicking the Q&A box at the bottom of your screen. Once we get to the end, we'll answer any of your questions. And so what are we going to cover today? First, we're going to talk about the economic recovery. Then we'll discuss inflationary pressures. And finally, we'll talk about bond and equity markets. With that, I'm going to hand it over to Darcy Nelson Smoot.
All right, thanks, Evan. So as Evan mentioned, I'll be talking about the economic recovery and some of the data behind that. So let's start with asset class returns. Equity market returns have generally been healthy this year. The S&P 500 finished the quarter up just over 15%. Small cap stocks actually outperformed, were up about 20% on a year-to-date basis. International markets underperformed, and in fact, emerging markets were down year-to-date, most of that due to declines seen in the third quarter. But overall, returns have been healthy. Bond markets, I'll mention, are about unchanged year-to-date. When we look at the individual sector returns, the best performing sectors this year are energy, financials, and real estate. These three sectors were most severely impacted by the pandemic. Oil prices crashed last year, which impacted the energy sector. Interest rates fell, which impacted the financial sector. And of course, the upheaval in the real estate market, particularly on the commercial real estate side with remote work everywhere, caused a lot of damage to the returns in these three sectors last year. So what we're seeing this year is actually a continuation of a bounce that started late in 2020. But I think notably, every sector is higher year to date. So this recovery really has been broad-based. So why are we seeing this recovery at all? I think one of the major tailwinds behind the returns in the stock market have been the fact that we're starting to see the other side of the pandemic. I'll let Ann address what she thinks might be the actual end of the pandemic, or if we may see that at all. But in general, case numbers have been trending down. Of course, this was also the case at the start of this year, early when the vaccine rolled out, case numbers started to fall. The subsequent Delta variant and subsequent wave that was caused by the Delta variant did dampen the reopening momentum a bit. But in general, knock on wood, no new variants aside, it's looking like the worst may be behind us. So when we talk about the economic recovery, one of the major pieces of data we look at is gross domestic product, or GDP. When the pandemic hit last year, there was a very sharp decline in gross domestic product. And in fact, the decline was much sharper than the decline seen in the financial crisis in 2008 and 9. Now, there was a subsequent recovery that was very quick. And in fact, GDP has not only recovered above 2019 levels, but it's actually trending nicely back to that long-term 2% growth rate that we've seen over the last 20 years. The other place we look for data on, how is the economy doing is the labor market. This is a little bit more of a conflicting picture. The top chart on this slide is showing total non-farm payrolls, or basically total jobs in the US. Now, when the pandemic hit, there was an almost instantaneous, a couple of months that we saw a loss of more than 20 million jobs in the US. Now, a lot of those jobs have recovered, but the recovery has started to lose steam. And in fact, we're currently still down about 5 million jobs relative to pre-pandemic levels. If I were to look at this non-farm payroll, this top chart in a vacuum with no other context, I might think, well, wow, geez, this economy really hasn't recovered. 5 million people are still out of work. This is a big problem. However, if we look at the job openings number, which is the bottom chart on this slide, there was certainly a dip in job openings through the pandemic, but job openings have not simply recovered back to pre-pandemic levels. They're actually 40% higher. This is a significant spike in job openings, with job openings at around just over 10 million. So, if I were to look at this in a vacuum, I might say, wow, this is a very hot economy with an extremely tight labor market. And taking all of this together, we are in a tight labor market, even with that loss of 5 million jobs. It does kind of seem like the 5 million people out of work should have an opportunity if there are 10 million jobs available. I think that there are a few hypotheses put forth to try to answer this conundrum that's illustrated by this juxtaposition of these two charts, which kind of begs the question, where are the workers? I think early on, there was definitely a fear of the virus, fear of getting sick, that was keeping people out of the labor market and not able to return to work. There was certainly an impact from the lack of childcare over the last year with remote school. Unemployment benefits or extra unemployment benefits that were put in place through the CARES Act, where in some cases people were earning more money not to enter the workforce, might have been keeping some people on the sidelines. We actually thought September might be a turning point. Not only were unemployment benefits expiring, but there was also the return to in-person school for most children. September has not been a turning point. The September jobs report was fairly weak. And so from here, I think a lot of the explanations are kind of anecdotal. As a parent of young children, even though remote school is back, there are things like 10-day quarantines for any exposure or any travel. You can't send your kid to school with the sniffles like you used to be able to. So there are those issues that still exist. You read the articles about the older worker that was kind of on the fence about retiring, decided to retire early because their 401k is nice and healthy with the stock market recovery. So I think that those are all maybe part of it. I think the best explanation I've seen is the fact that savings rates are higher, not only from the fact that people receive fiscal stimulus, but also from brokerage accounts, the stock market recovery, those are nice and healthy. And people just haven't been spending as much on travel and leisure. So, I think people out of the workforce are waiting it out, waiting for a better job, and are able to have one parent step into that childcare role. And that's kind of the best explanation, I think, at this point. But in any case, it's certainly a very tight labor market. I think shouldn't surprise anybody that labor force participation dropped sharply in the pandemic to about 61.6%. This chart shows labor force participation going back to 1948 and shows the rise in the participation rate through the 70s and 80s as women entered the workforce. But it's really been on a downtrend after the peak in 2000. So there are certainly demographic factors that are at play now that have been in play for about 20 years. The population is aging, for one, and we also have lower birth rates, which means fewer young workers are entering the workforce. So we may see this participation rate tick higher as the savings start to run out, people begin re-entering the workforce, but it may not be going back to that 66% level. It may be trending back to around 63%. So with that, I'm going to hand it over to Steve, who's going to run through some of the inflationary pressures that we're seeing.
Great. So thanks, Darcy. So yeah, inflation has certainly been in the headlines recently. And one of the key drivers of inflation this year has been a surge in shipping costs. So this is a chart of the Baltic Index, which tracks spot prices to ship goods by sea. So in the first quarter of 2020, the price of shipping goods was about $1,600 per shipping container. And by the end of September and into October now, that bill has climbed to over $10,000. So the rate for a business to ship a container of goods from Asia to the West Coast, for example, is now 6 times higher. So what's driving the higher prices? Well, there's really 2 factors. One, Americans have shifted their spending patterns away from services. So, during COVID and during the shutdowns, they were spending less on going out to restaurants and traveling, and certainly spending more on electronics and home furnishings and other goods that they were buying online. In addition, the ports have emerged as a main bottleneck. So if we look at what's going on in ports in Los Angeles and Long Beach off the coast of California, which make up about 1/3 of all U.S. imports, they just can't unload the ships fast enough. If we look, I think it was earlier this week, it was reported about 90 ships were anchored off the coast, just waiting to be unloaded. And before the pandemic, it would have been unusual if you had 2 or 3 ships at anchor. So the reason for the bottleneck is a labor shortage. The ports can't hire enough workers to unload the vessels, and nor can they find enough truck drivers to haul the containers away once they've been unloaded. So the good news so far is the market doesn't think this is a long-term issue. For one, we think consumer spending should normalize over time. We do expect this to be a difficult holiday season for many retailers, though, but shipping prices should start to ease in 2022. The other issue that we've seen is a global shortage in semiconductor chips. So we talked about this huge surge in purchases of consumer goods by US consumers, and that ranges from cars to computers to appliances. It's led to a significant increase in demand for chips. And at the same time, we've seen this surge. Many of the plants that are manufacturing the chips in Asia have been slowed or hit with temporary closures due to COVID restrictions. So this has really been a perfect storm and has caused a real shockwave to the supply system. It now takes over 20 weeks from the time of order to delivery for a chip. And although the manufacturers are doing everything they can to eke out more supply, the bad news is there really aren't any quick fixes. Bloomberg earlier this week, they reported that the chip lead times are slowing, but delays will likely continue for the foreseeable future. There's a number of plants that are currently being built here in the US, but it's going to take years for those plants to come online. Another issue we've been dealing with is higher commodity prices. And these have risen again due to supply chain disruptions. We've also been impacted by droughts across the Midwest and the West. So this chart it's a little bit busy, but it shows the price of oil, copper, lumber, steel, and wheat going back to January of 2020. I think one of the interesting data points here is if you look at lumber prices, which is represented by the green line, they surged early in COVID as many of the lumber mills went offline and demand picked up as people were sitting at home and looking to remodel their rooms and houses. And at the same time, supply chain issues have started to resolve themselves, or more recently, they've started to resolve themselves. And prices are now falling back, still above pre-COVID levels, but they've certainly eased from the peak that we saw over the summer. Jerome Powell in the Federal Reserve believes that the higher commodity prices are transitory, and prices will start to ease, much like lumber prices have done so far this year. In the meantime, though, we've seen companies like Procter & Gamble, which we own, they've come out and announced that they'll be passing on higher input prices to consumers. So we can all expect to be paying more for items like toothpaste and shampoo going forward. Oil prices are now trading at their highest level in 7 years. After cratering at the start of the pandemic, oil is now trading at above $80 a barrel. So we're still below the prices, the peak prices we saw in 2012 and 14, when oil was more than $100 a barrel. And the reason for the higher prices is supply remains very tight amid strong demand as economies are starting to open back up. We've also seen higher than normal demand coming from countries like China and India and Europe. They're dealing with shortages in coal and natural gas, so they're turning to oil as an alternative. So this is a chart of energy prices. In this chart, we're comparing price of oil, natural gas, coal, going back to 2012. And you can see that as of late, prices have started surging around the world. This is due to a range of weather and geopolitical factors, which have restricted the supply of coal and natural gas. If you look at the orange line, which really stands out, it plots the price of natural gas in Europe, which has spiked considerably. Europe is their gas supplies are now at their lowest level in more than a decade. There's some political issues going on here with Russia. Russia is one of the largest suppliers of natural gas to Germany and parts of Europe. But prices have jumped so much. There's a real concern of an energy crisis heading into winter in parts of Europe. We're a little more fortunate here in the U.S. We can expect to pay higher energy prices, but we certainly have enough supply to get us through the winter. And as Darcy commented, we are dealing with labor shortages. Employers are having to increase their hourly wages to attract workers and fill those openings. The Labor Department recently reported a 4.5% increase in hourly earnings compared to a year ago. That number was also up 4% from the month prior. So it's difficult to dismiss rising wages as being transitory, as the wages tend to be rather sticky. This is a positive. You think about the positive for U.S. workers who really haven't experienced significant wage increases over the last decade. So it's putting more money into those workers' pockets. But the wage increases are starting to eat into overall business optimism as employers are having to decide, do they either absorb those higher costs or do they pass them on to consumers? The next chart we're looking at is the Case-Shiller Home Price Index, and it tracks home prices in the U.S., shows that housing prices have reached record highs as they were up nearly 20% from this time last year. So the surge in housing has been driven by, it's a reaction to the COVID pandemic as buyers have been fleeing cities for the suburbs. And they were enabled to do this by being able to borrow money at very low interest rates. But I think it's also an indication that we are dealing with a lack of supply of homes, especially for lower end or entry level homes, which has been driving prices higher. So this chart looks at shelter prices. Now this is the shelter prices for renters. What's interesting about this chart is the shelter prices contribute to about 40% of the total CPI or consumer price index. And this shows rents are rather muted, right? Rents have fallen, but they really haven't bounced back as there hasn't been much movement in the rental market this year. But it's also important to note that shelter component is measured on a semi-annual basis. So we think there's a long interval between when prices are gathered versus what current prices are actually at. So we believe that the shelter prices that contribute to the CPI are being underreported, and that the true costs of rentals are a bit higher than what's showing up in the current government data. In fact, this chart, which we prefer to follow, shows rental prices published by Zillow. And we think this is just more accurate of what's going on in the marketplace. So after declining for the last 5 years, rental prices are up more than 7% this year. So this again shows rental prices are accelerating at a faster pace, sorry, what's being reported in the government data. And then this chart is a chart of the consumer price index. It goes back over 100 years. And you can see that in the early 1900s, there were periods of hyperinflation where prices were increasing at a rate of more than 12% a year during World War I, and then followed by periods of deflation during the Great Depression. And then we saw significant inflation pick back up during World War II, and then the 1970s. That was due in part to oil embargoes, but really the last 40 years, inflation has been subdued in the U.S. as the Fed has been quick to respond to any pickup in prices. So we think that the current readings of the CPI being just over 5% is actually understating the true level of inflation that we're seeing in the U.S. economy per the shelter prices that we were just looking at. But as supply chain issues get resolved, and as the Fed has come out and indicated that they're willing to start increasing rates sometime next year, we think inflation will be elevated in the short term, but it won't reach levels that will be crippling to our economy going forward. And now I'm going to pass it off to Brooks, who's going to talk about the bond and equity markets.
Thanks, Steve. Yeah, I'm going to speak about money supply, and then I'll talk about the markets. This chart shows two things. The blue line is M2, a measure of U.S. monetary supply, excuse me, and money supply growth in the last 12 months is at the highest level it's been at since World War II. And you can see, the chart shows that in 2020 with a rather substantial increase. This is due to both the Federal Reserve's purchases of securities, which is essentially electronic money printing, and is exacerbated further by the amount of fiscal stimulus that we've seen since the start of the pandemic. You may remember in last year's presentation and prior quarters, we did a chart comparing US money supply growth in the last decade to that of Weimar Germany. And what we've seen here is an 8-fold increase in money supply. In Germany in the same period, there was a septillion-fold increase. That's a 1 with 24 zeros after that. So we're not quite at that level. The next slide's going to show the increase in the federal balance sheet. For a very long time, up until the financial crisis, the assets held by the Federal Reserve was about just under $1 trillion. And in the financial crisis, you may recall, as interest rates were lowered to virtually zero, the Fed instituted quantitative easing as a measure to further support the overall economy. And in the period from 2008 to 2015, there was an increase from $1 trillion effectively to $4 trillion. You can see what it shows on the chart is in 2018-19, the Fed started to reduce the value of their holdings. The pandemic hit, and very quickly they increased those holdings dramatically, adding another $4 trillion to the point now where they are holding about $8.5 trillion. That's amazing to us, especially since the same thing has been going on in foreign markets. And the conundrum is why, with inflation running, as Steve showed, in the US at 5.5%, why are 10-year Treasury yields still only at 1.5%? And that 5.5%, by the way, as Steve said, may in fact be understating actual inflation. It's even more significant when you look at what's going on in Japan and the European Union. Germany's 10-year bond is yielding negative 0.2%. I think that as we see the pressures growing with inflationary pressures due to pandemic disruptions, I think that's likely to spread into other markets. And so there's likely to be substantial pressure on rising rates. You can see that with the steepening of the yield curve. The yield curve is a measure of, or a graphical depiction of, the interest rates on varying maturities at single points in time. So the green line is showing where US Treasury yields were from 1-month T-bills to 30-year Treasuries on September 30th of 2020. And the blue line shows those same rates just at the end of the third quarter. Very marginally, what you're seeing, rates under one year in maturity have actually declined, but maturities beyond 5 years out to 30 years have increased by a full percentage point. So what are we seeing in the markets? We've got both tailwinds and headwinds, things that are helping the economy and therefore the market. COVID is declining. Will there be another surge from some other variant? We'll defer to Ann's comments in that regard later. You know, we are continuing to see monetary stimulus from the Fed. They are starting to give signals that they're going to start withdrawing that stimulus in a very gradual way, but they haven't really started in earnest. You may recall the comment, the phrase TINA. There is no alternative. If you want to not be in stocks in the liquid markets, there's really not much of a return. If you're buying a treasury note that yields 0.2% with inflation at 5%, you're actually losing money on a real basis. Companies are continuing to spend money and spend money in some cases on buybacks. That helps the overall market. And as we've all read in the news of late, there is ongoing discussion out of Washington with potential increase in fiscal stimulus, though the outcome of that is very much in doubt. On the other side, the headwinds to both the economy and to the markets, Steve highlighted supply chain issues, rising raw materials, energy prices rising, and those are all causing inflation. As a consequence of that, margins in companies' earnings are under pressure as their cost of goods sold go up, and then political impacts with a potential tax hike increase, central banks around the globe, not just the Fed, withdrawing support. And just in the US, we have the wonderful debt ceiling debate as the parties argue over who's responsible for all of the borrowing that we've seen. So turning to the equity market, to the valuation, this is a chart of the S&P 500's forward earnings, price earnings multiple. So it's the price of the S&P divided by what analysts expect companies in aggregate to earn. And what we've seen really since the financial crisis is a fairly dramatic increase in the price earnings multiple, spiking up in the pandemic as earnings started to fall to what has been a post-dot-com high in the low 20s. But most recently, what you're seeing on the end of that line is a decrease in the price earnings multiple. So valuations are still high, but they are moderating. Why? They're moderating because the earnings per share that companies are reporting have been growing much, much faster than the price of the underlying index. So the blue line is showing that earnings per share this year have gone from, they're up about almost a third. Meanwhile, the S&P 500 price is up just over 15%. So when you take the green line divided by the blue line, you end up with the forward PE ratio, which is depicted in that yellow goldish line below, and that's caused the PE ratio to decline about 10%. So the things that we're doing in portfolios, we have implemented changes in our portfolios that will that are building positions that should do better in an inflationary environment. That includes real estate, as Darcy mentioned. We've also been adding companies that have pricing power. Steve mentioned Procter & Gamble as an example. Others, technology companies, pretty much there's no alternative. If you're a Salesforce or Microsoft user and they increase prices, you're going to go along with it, generally speaking. Lindsay's another company that has substantial pricing power. In an era that we expect rising interest rates, then we look for companies that have borrowed longer term debt at what are now historically low rates. Companies like that include Verizon, Iron Mountain, Home Depot, and Comcast. And then lastly, maintaining relatively short durations in our bond portfolios so that we don't suffer if and when bond rates interest rates start to rise. We're researching ways to benefit from rising commodity prices. If in fact inflation gets out of control, there's a possibility we could even add a position in gold. Gold does not generally do well in the early stages of rising inflation, but when you hit either deflation or extreme inflation, gold tends to be a great store of value. And lastly, we are not ignoring cryptocurrency. We don't own any. There's a couple of arguments that are valid for possibly owning cryptocurrency. It is a very volatile kind of asset. It's highly speculative, but it is very dramatically uncorrelated to the other parts of the overall financial markets. And that is one reason. The reason that we haven't pursued it is, as I said, highly volatile, A, and B, currently attracting a great number of activities that are not something that we want to be involved in, be that hacking, ransom, or drug deals, or you name it. So, but we're looking at it. The Economist reported that in the second quarter, the dollar volume of transactions conducted in cryptocurrency was equal to the dollar volume of transactions settled by Visa on credit cards. It is something that's becoming a very real thing in the overall markets. So with that, I will turn it over to Evan to share the conclusions, and then we'll begin Q&A.
Thanks, Brooks. So in conclusion, the US economic recovery continues with fits and starts, primarily due to the Delta variant. There's the conundrum in the labor market. Where are the employees? We've seen rising food, energy, wages, and commodities, which are all pointing to higher inflation. There's risks of policy mistakes with both fiscal and monetary stimulus. The Fed is beginning to discuss tapering, and inflation will likely lead to higher rates, although the timeline and how quickly that happens is unknown. And we've seen some inflationary pressures, which will challenge low global bond yields. And finally, earnings growth has driven price to earnings ratios lower and the market higher. And so with that, we will begin questions and answers. If you click the Q&A box at the bottom of your screen, you can type in questions and we'll be happy to answer them. So the first one I have here is in regard to emerging markets. If you recall, we showed that emerging markets were down last quarter. We actually made the decision to marginally increase our exposure to emerging markets. Darcy, do you want to talk through that decision?
Yeah, definitely. That's a good point. And, I think that it is a little bit painful to believe that to make an investment decision and then not see it work out in the short term. What I would say is that it's kind of a short-term phenomenon, and what we know is that emerging markets over the long term come with a higher risk reward profile. So they tend to, over the longer term, have more volatility, but have higher returns. The decision that was made to add to emerging markets had more to do with its performance in inflationary environments. So emerging markets essentially outperform in all inflationary, in low and rising inflationary environments, which is what we think we're currently in, and in high and rising inflationary environments. Basically, the only environment emerging markets underperform in is in low and falling inflation, which is essentially deflation. That's the scenario we really can kind of rule out, I think, at this point. So, emerging markets are levered to commodity production, which is another inflation hedge. The reason that emerging markets were down in the third quarter had a lot to do with regulations in China. The Chinese government started to crack down on for-profit education, gaming industries, gambling industries. They kind of have picked out certain, industries that they want to crack down on, and that's being read as a longer-term trend away from capitalism. I think is kind of the short way to put that. So that's kind of what impacted emerging markets in the third quarter. We're invested. We take a much longer time horizon with our investment, kind of in the at least 2 to 5 years. So that's where we're looking with the slight add to emerging markets, and I would say it was very slight as well.
Great, thanks. The next question is on money supply growth. You want to maybe pull that chart up. The question is, what is happening with M3? Brooks, you want to talk that through?
Sure. M3 is also growing at an even higher rate. M2 is generally the rate that is most closely followed in the financial markets, which is why we've depicted this. I didn't in this presentation make this note, but the gold line is the velocity of money, and what we've seen in the post-financial crisis period is a doubling in the money supply, and yet we haven't up until recently seen a substantial increase in inflation. Part of the reason for that is this gold line velocity of money has been declining since the dot-com era. If you think of these statistics as the supply of goods in a store, that's money supply, and turnover of those goods, that's velocity. So what we've seen is the Fed increasing money supply, but because of the post-financial crisis rules, most of that money has been sitting in the banking system to stabilize the banks. It has not been stimulative to the economy. Similarly, in the financial crisis, we saw very substantial stimulus coming from the government to middle and lower income taxpayers. And what did they do with that money? Did they run out and spend it? No, in fact, and it shows it varies very significantly in the velocity of money statistic, where you see it dropping during the pandemic. It basically went into savings, and people thought, well, I better save this for a rainy day. So there's a good chance that when the caseloads start to come down, people feel more comfortable about going out, that we'll see even further inflation pressures coming from that fiscal stimulus.
Great, thank you. The next one is in regards to the GDP chart. And the question is, what does the term chain dollars mean? Steve, do you want to address that?
Sure. If we go back, can we go back to that chart?
Sure. I can take that one. Let's see, where was it? It was in GDP. So the change dollars is just basically a method of adjusting real dollar amounts for inflation over time. So that's the standard, or gold standard GDP metric, if you will. So it's not thrown off by any inflationary values in the amount of GDP.
Thanks. Next, we've got a couple of questions on cryptocurrencies. Do you want to actually go to our cryptocurrency chart at the end? And I'm happy to talk through this a little bit. So we actually included a chart on cryptocurrencies. If you go down one more, and then we ultimately decided not to include it because this chart is as of 9/30, and even now it is so out of date. So, we're certainly looking at cryptocurrencies as an asset class. As Brooks mentioned, it's not correlated to the bond or stock market, which makes it kind of interesting. I think the issues with it, is you can see from this chart, is it's just so volatile. And so because of that, we don't think that it has a place in our core portfolio. We are advising some of our younger clients who do have risk tolerance for this, that, if you want to have 1 to 5% of your net worth in cryptocurrencies, it's got to be something that you can afford to lose, because it could double or it could go to zero. The other issue with investing in cryptocurrencies under traditional custodians like Charles Schwab is there's no way to directly invest in them. There are ETFs like the Grayscale Bitcoin Trust, and there's a new Bitcoin futures ETF, but you're not investing directly in cryptocurrencies. And because of that, the tracking is not quite there. And the expense ratios are 1 to 2.5%. So for these reasons, like I mentioned, it's not part of our core portfolio at this time. And let's see, we got another question. Why aren't bond prices falling more? Steve, do you want to discuss that?
Sure. Yeah, no, it's a great question, and one we've been asking as well, is when will the bond market start demanding real returns? So it's probably can be answered in really in 2 ways. One is the bond market is not pricing in inflation higher than what the current levels are. So it doesn't think that the economy is going to be running as hot as some of us, including kind of what we're thinking, that inflation will be running higher than what is being currently priced in. And then second, if you take a look, and I think Brooks alluded to this in one of his slides, is that US yields are still relatively high compared to global yields. Germany, last time I looked, their 10-year bond was still trading at a negative yield. Japan is still has negative yields in the debt they're issuing. So when you compare what's going on globally to the U.S. Fixed income markets, our yields are still relatively high, even with a 10-year at 1.5 or 1.6%. So until we see global yields pick up, we think that's going to put a relative ceiling on U.S. yields. But with that said, the bond market could change very quickly if the government's inflation numbers start to actually show what we think is the real inflation numbers. Those numbers could change very rapidly.
Thanks, Steve. Next question here is, when will the pandemic be over? When will things return to normal? Anne, would you like to field this one?
Sure. Thanks, Evan. And good morning, everybody. This is a question that people have been asking now for quite a while. And I will just say up front that, of course, there is no definitive answer to that, as much as we would all like to have one. Some epidemiologists and other experts do believe that, at least in the US and Western Europe, we may be at what we would call the beginning of the end. For example, in Portugal, which is now 85% vaccinated, there are glimmers of hope. Case numbers have fallen significantly, as have hospitalization numbers, as well as we've seen that in some areas of the US with high vaccination rates. Case numbers have dropped significantly in the US since the Delta peak on September 1st. The however is that millions of unvaccinated people in this country are still susceptible to the disease, although many do likely have some degree of natural immunity from previous infection. So I think the caveat about this being the beginning of the end is that we don't have any new variants that are able to evade our current vaccines and treatment protocols. And we do need to continue to make progress on vaccination, both in the United States and elsewhere. For example, Africa is less than 5% vaccinated, which is a huge hole in the world's efforts on that front. What most epidemiologists think is going to happen is that as vaccine uptake grows and vaccine rollout does make headway in parts of the world where it's currently low, COVID-19 is expected to become endemic. So what does that mean? It means that the disease is constantly present, kind of at a low level in a particular location. Many people who have studied all of this and are keeping up on it believe that periodic boosters of COVID-19 vaccines will be needed because immunity, whether it is natural or vaccine mediated, does seem to decline over time. In some respects, this is similar to the flu shot that's reformulated annually and that most of us just go off and get in September or October. If you look at the history of pandemics, again, at some point, so many people have been infected, so-called natural immunity or vaccinated when we have had vaccines in the more modern era, that eventually the virus runs out of people to infect. And so that's when the pandemic ends. And the people that are still prone to infection at that point are people whose immunity has either declined or were never infected in the first place. So putting a number on all of that is really hard to do, but I think that if you kind of take the preponderance of the opinions of the people who do this for a living, they are cautiously optimistic that by next summer, things may be significantly different in a good way. Again, particularly in highly vaccinated areas and highly vaccinated countries.
Thank you, Anne. The next question is in regards to the surge in shipping costs. If you want to bring that chart up, it's a two-part question. How long do you think it will take before the shipping backlog dissipates and shipping costs return to historic levels? And how large of a component of the overall cost of goods are shipping costs? Darcy, do you want to talk that through?
Sure, yeah. I think as far as how long it will take to unwind this backlog, I mean, it's a pig in the python problem that I think longer than everybody thinks is what I would say. So not a few months, probably a year or 18 months is what I've heard. To answer the second question, how large of a component are the overall costs of our shipping costs? That's a good point that I've read into. Shipping costs are very, very small percentage of total costs for most companies. Now you can imagine that differs for a company that sells small electronics versus a company that sells enormous teddy bears or furniture or something like that. So it definitely differs from company to company, but for overall in aggregate, shipping costs are a very small percentage of most companies' business. But when there's a fourfold or sixfold increase, it starts to become more meaningful. So the surge in shipping costs is certainly inflationary, and it's certainly eating into margins a bit. I don't think that's as impactful as, say, raw materials prices, for example, for most companies. But that's a good question.
Yeah, and I just add to that, Darcy, I think there's a correlation with the economy opening back up. So if you think about what consumers have been spending their money on, it's been mostly consumer goods. Once we get to a place where people are starting to travel more, going out to eat more, they're going to be shifting their dollars from buying goods into more services. And that should alleviate some of the pressure on the backlog that we're seeing in our ports around the world.
We've got a related question. Are you invested in global shipping stocks? So Darcy, do you want to address that one?
We're not actually. There's nothing direct right now. So nothing, yeah, we don't have a direct investment in shipping stocks at the moment.
Okay, next question. Is there a mispriced security opportunity or a danger like for bonds? Brooks, would you like to address that?
To the degree that I can, sure. There's always mispriced securities in the market. And I think the question is not just, is it is it mispriced for a particular bond, but for the asset class as a whole? Yeah. I mean, if you look at the level of yields over the last 40 years and contrast that to the level of inflation, we've had over the long haul an average real rate of return. That's the yield on the bonds less the yield of inflation. That's been between it's been between 0 and 4%. In the last decade, it's averaged about 2. In the early 80s, it averaged about 4, and we are now at a level where it's negative. It's been that way for some period of time. How long can that go on? It can go on a long time, but eventually it's going to have to return to a normal level. And the question is when. I think that if we see the inflation pressures that we've highlighted continue, that would be that will eventually show up as a very negative experience in the bond market. The Fed and market watchers have been saying, oh no, this is just cyclical. It's just due to logistical disruptions from shipping, et cetera, that have caused the supply to be supply of goods, whether it's chips or teddy bears. The supply of goods have been constrained. Well, it remains to be seen. If Darcy's right and we see 18 months for the shipping problem to get worked out, then psychology will start to be impacted as prices continue to rise. Headlines today are even talking about, if you're going to do your holiday shopping, start early because you may not have supply at the in late December, just before the holidays start. So.
Okay. The next question is on housing. Do you see a property bubble? Steve, would you like to answer that?
Yeah, so we discussed property values are up close to 20% year over year. And I think the latest data, the Case-Shiller data that just came out this week actually showed a slight slowdown in housing prices. But in terms of a bubble, bubbles are very difficult to predict when they're going to happen or when they're going to pop. But I would say that there's so much demand and so little supply of homes in the U.S. that we don't think there is a property bubble. If anything, if interest rates do move higher, if the cost of borrowing moves higher, that will certainly slow the housing market. But we don't foresee a crash in the U.S.
And we've got a follow-on housing question. Since housing starts have declined, isn't that a definitive sign of a slowing economy? Darcy, you want to answer that one?
Yeah, I think I would say that would be something to watch if it were coupled with other signs of a slowing economy. In this case, I do think the housing starts decline had a few things behind it. One, we've got a base effects issue. So a lot of the numbers that we're looking at, whether it's a month over month or quarter over quarter or year over year basis, we have to remember what we're comparing to. So if we're comparing to, a quarter ago or a few months ago when we had an extremely hot housing market and homes were being built as fast as we could, lumber was 4 times the price it normally was. We have to keep that in mind. And the other reason I would say, I don't see this as a sign of a slowing economy is I think part of the housing start decline was simply supply crunch related. So the lack of building materials, lack of labor to build these homes, I think that was a big part of that housing start decline. And then I think the other signs that we're seeing from in aggregate companies reporting in quarters recently is that there are all these supply chain problems, but demand is healthy. We keep hearing this from companies across all industries and sectors that demand is very healthy. It's just a matter of meeting that demand and coming up with the supply to meet that demand. So I think that, we're always on the lookout for signs of a bubble. And I'll add to Steve's point on the home market growth. I think one of the trends driving that right now is the millennial generation coming of age to buy a home. And the pandemic is a time I think a lot of people scratched their heads and said, what am I going to do with my life? And I guess a lot of millennials decided I'm going to buy a house. So that's been driving the new household formation is, I think, driving a lot of that demand. And I think that there are still legs behind that that should prevent a bubble situation.
Thank you. We have a question on the outlook for the cruise industry. How have cruise stocks performed? Darcy, you want to take that one as well?
Sure, that's a great question. I think we actually did look at cruises, probably 8 months ago, something like that, when we were looking for, what are things that people will be eager to do. And we thought, cruises were, of course, disproportionately hurt in the pandemic. Are they cheap right now? Is there a mispriced or an opportunity there? There's still, I can show some charts if this is helpful. We've got Carnival. I'll just pull it over if everyone can see this. This is Carnival and Norwegian cruise lines over the past, call it 3 years. So they haven't recovered. They're still, probably 50% lower roughly relative to where they were pre-pandemic. I think that our biggest concern with cruises, and again, we did consider them, we did look into them, they have extremely high levels of debt, which we noted is something that we actually would see as a positive if we're heading into an inflationary environment like we think we do. The distinction is that in the case of the cruise lines, it's not inexpensive debt. These are very, very risky companies for quite obvious reasons. So their debt loads, their interest coverage ratios are very unattractive. And I think it is kind of the longer these sailings get pushed out due to restrictions and fears that people have of getting sick on a cruise, I think the scarier that looks for the cruise companies. So that's why we've stayed away, and they've not performed well. The way we did take make an investment in a company that we thought is levered for the reopening momentum, and that was in Booking Holdings, which is an online travel agency. It doesn't have a supply chain, which is kind of nice. And so it's not subject to those issues, and it's really able to participate in that. People itching to travel because it's an online travel agency. So that's the way we decided to play it. It was also a company that was just much more healthy from a financial perspective.
Okay, the next question we have is, how do you strategize when any of the stocks you hold takes a significant and ongoing drop? Do you buy more or do you wait it out? Examples, Visa. Darcy, do you want to talk that through?
Sure, yeah, I think that's a great question, and I don't want to hedge with my answer, but it does depend on the circumstances. I think there are cases where a company declines, and let's use Visa since that's the example that's been brought up. Visa is down, is down today and was down this week because it reported earnings, and while financial transactions have been on the rise, particularly, and actually non-cash transactions have been on the rise in the pandemic. The impact that Visa is feeling from the pandemic is a loss of revenue on cross-border transactions. So these are transactions that are made often when people are traveling and not in their home country. Those are much more lucrative transactions. Those transactions help boost Visa's margins. I think the read through from in the analyst community on Visa's earnings report this week was they don't expect the cross-border transactions to return to 2019 levels until 2023. So there's definitely, the pushing out of that timeline is negative for Visa. Now, in our case, that's a good question. Do we wait it out? Do we add more? What do we do in this case? I think with Visa, there are actually other positives that have accelerated the long-term trend or the long-term tailwinds for Visa, namely anything that has pushed people away from cash to using credit or debit cards. That I think we can all agree has accelerated during the pandemic. And that I think will benefit Visa in the long term. And again, our horizon is longer. It's at least 2 to 5 years. So I think that we would hold Visa. I think if it does drop lower, we're always going to be mindful of valuation. And that's, I think, a metric that we would watch very closely to say, is it time to add more? I don't think it is currently, but that's the calculus that goes into those discussions that we have in the research meetings.
All right, thank you. And with that, we are at the end of our hour. So I would just like to thank all of the attendees for joining us today. If you have any follow-up questions, feel free to contact us. But thank you again, and we hope to hear from you soon.